Every time prices go up, something small slips away from you. Groceries cost more, rent creeps higher, gas takes a bigger bite out of your budget. Month after month, it adds up. And if you've ever looked at your paycheck and thought, why doesn't this stretch like it used to? You're not imagining it. You're not being dramatic. You're watching something real. You're watching one of the quietest transfers of wealth in human history. One that repeats across generations, not because people are careless, but because the system is built to make it happen. Because inflation doesn't just make life more expensive, it quietly rearranges who gets to own the future. Welcome to Moneta Historica, where the hidden relationship between money, power, and history is unveiled. For most people, inflation feels like chaos, like the world is slipping, like there's no solid ground. Prices move faster than you can plan. Savings feel like they're shrinking in your hands. And the longer it goes on, the more you realize you can do everything right and still fall behind. But here's the strange part. For the powerful, inflation isn't chaos. It's order. It's predictable. It's manageable. In a way, it's useful. It's how the modern economy keeps itself alive. It's how governments pay for wars without openly raising taxes. It's how corporations make yesterday's debt feel smaller tomorrow. And it's how the wealthy can watch their assets multiply while everyone else is fighting just to keep up. So the question isn't really why inflation happens. The real question is, why is it allowed to happen again and again? Why do we keep rebuilding the same machine? To understand that, you have to go back to a time when inflation wasn't treated like a normal part of economic life. It was treated like an emergency, a sign something had gone wrong. In the early 20th century, most major economies were tied to gold. Money wasn't just whatever the government says it is. Paper notes were backed by something physical, metal stored in vaults. Gold didn't care about elections. It didn't care about political promises. It just sat there heavy and stubborn. That made money scarce and usually stable. And it meant governments couldn't print their way out of mistakes. If you ran a deficit, you either raised taxes, cut spending, or admitted defeat. Inflation, when it showed up, usually came from war, collapse, or loss of discipline. Something breaking, something extreme. The idea that a government would choose inflation on purpose, like it was a tool, would have sounded unthinkable. But then, everything broke. The Great Depression in the 1930s shattered the illusion of monetary restraint. Prices fell. Wages collapsed. Banks failed. Entire economies froze, not because inflation was too high, but because inflation was too low. Deflation doesn't sound scary at first. Prices falling sounds nice, until you realize what it does to behavior. When money gains value over time, people stop spending it. Why buy today if it'll be cheaper tomorrow? Businesses lose revenue. Workers get laid off. Demand collapses further. And debt, this is the killer, debt becomes heavier by the day. Because a debt is fixed, but your income isn't. So the real burden grows. It's an economic death spiral. And it changed everything about how policymakers thought about money. They started to fear deflation more than inflation. And once that fear took hold, the logic of the system began to flip. By the end of World War II, inflation had transformed from a danger into a tool. Governments emerged from the war buried under mountains of debt, some of them owing more than 200% of GDP. That's not a small problem. That's not something you budget your way out of. They couldn't pay it back honestly, so they didn't. Instead, they let inflation do the work. Through the 1950s and 1960s, global debt quietly shrank, not because nations suddenly became more responsible, but because the real value of that debt melted away. $1 trillion of war bonds didn't mean the same thing 10 years later. What once felt like a crushing burden slowly became manageable, simply because the currency being used to repay it was worth less. The system learned a lesson, one that would define the modern world. Moderate inflation can solve impossible problems without anyone noticing. Not with a headline, not with a vote, not with a public argument, just slowly, quietly, automatically. Then came 1971. President Nixon closed the gold window, ending the dollar's convertibility to gold. It was supposed to be temporary. It became permanent. And in that moment, money stopped being a measure of value and became an instrument of policy. For the first time in modern history, the world's dominant currency wasn't backed by metal. It was backed by confidence, by belief, by the assumption that everyone would continue accepting it. You couldn't exchange dollars for gold anymore, only for more dollars. Inflation wasn't just a symptom now, it was a feature, a design choice. From that point on, the rules of the game changed. Money could be created in huge quantities as long as people kept believing in it. Governments could borrow more freely. Banks could expand credit faster. And investors learned something that most ordinary people weren't told. In a managed inflation system, the real winners aren't savers, they're borrowers. Because inflation quietly flips the logic of money. If you hold cash, inflation steals from you. If you hold debt, inflation can reward you. Every year prices rise, the real value of what you owe goes down. $1 million mortgage today might feel crushing, but in 20 years, after steady inflation, those same monthly payments feel lighter compared to your income and the general price level. Meanwhile, the nominal value of assets, houses, stocks, land, tends to rise with inflation, or even faster than inflation. Inflation doesn't just shrink debt, it amplifies wealth. That's the paradox at the heart of the modern system. The same force that drains the poor can support the rich. And that sounds like a conspiracy, but it isn't. It's arithmetic. A debt-based economy relies on credit expansion. Credit expansion means more money and more claims on money. Without inflation, the system becomes rigid. Every dollar owed would need to be repaid in dollars that hold the same value they had when borrowed. And when the system is built on rolling debt forward, on refinancing, on new borrowing, that becomes impossible. So governments, central banks, and corporations quietly converged on the same conclusion. Better to let the currency lose a little value each year than to let the entire system collapse. But what happens to the average person inside this arrangement? The answer is simple, and honestly, brutal. Wages rarely keep up. Prices rise faster than paychecks. Savings, once the cornerstone of middle-class security, become a slow-motion loss. And the people who can't afford to own, who live on earned income rather than capital, find themselves running on an invisible treadmill that never stops, because inflation rewards ownership, not labor, and it punishes caution. It turns thrift, once a virtue, into a liability. The system tells you to save, but penalizes you for doing it. When your bank offers you 3% interest, but inflation is 6%, you're not earning. You're paying to keep your money still. And this is where the system reveals itself. Because inflation doesn't just raise prices, it quietly takes purchasing power from everyone who earns and saves. That's why Milton Friedman, one of the most influential economists of the 20th century, put it so simply: inflation is taxation without legislation. It's like carrying water in a bucket with a small hole in the bottom. You don't notice at first, but over time, you do. Meanwhile, someone who borrows at 4% to buy property might watch that property rise by 10% in nominal value. That's not market luck. That's the structure. Because inflation doesn't redistribute money randomly, it redistributes it upward. The people closest to the source of new money, banks, governments, large corporations, get access first, while it still holds its full purchasing power. By the time that money reaches everyone else through prices, wages, and everyday life, it's already diluted. This pattern has a name: the Cantillon effect. Named after an 18th century economist who noticed the structure centuries ago, new money benefits whoever touches it earliest, before prices adjust. Back then, it was kings, courts, and merchants. Today, it's financial institutions, markets, and the largest asset owners. Inflation doesn't just change prices, it changes who gets to live above them. After 1971, the logic of money flipped for good. What once punished overspending began to reward it. What once disciplined governments began to liberate them. And as credit replaced savings, inflation became the quiet glue holding everything together. By the 1980s and 1990s, central banks perfected the balancing act. They promised price stability, aiming for roughly 2% inflation, just enough to keep the economy expanding, but not enough to cause public panic. 2% sounds harmless, almost scientific, almost boring. But over a generation, it cuts the purchasing power of a currency in half. And here's where it gets even more uneven. Ordinary people watch groceries double. But wealthy people watch assets double too. And then some. Because steady inflation makes debt predictable. And the rich don't fear inflation. They position themselves for it. They own the houses that appreciate, the businesses that can raise prices, the stocks that reprice upward, and the debt that gets cheaper to repay every year. Inflation becomes their business partner, a silent ally that magnifies advantage. Governments love it too. Public debt becomes smaller in real terms the longer inflation persists. That's why deflation scares them. Deflation exposes fragility. It makes debt heavier. It forces defaults. It pops bubbles. It drags problems into the light. Inflation does the opposite. It hides the cracks. It fills the gaps. It pushes pain downward. And bankers, they love inflation most of all, because it creates a world that can't stop borrowing. If prices are always rising, saving feels irrational. You have to invest. You have to chase yield. You have to do something with your money because doing nothing guarantees loss. And every chase means another loan, another product, another derivative, another fee. The entire architecture of modern finance, from mortgages to bonds to stock buybacks, leans on one assumption: tomorrow's money will be worth slightly less than today's. The further down you are in the system, the less control you have. If you live on wages, your income adjusts slowly. If you live on assets, your wealth adjusts fast. If you live on debt, inflation either crushes you or makes you richer, depending on the kind of debt you hold. A credit card balance is poison. A fixed-rate mortgage can be leverage. The rich know the difference. Most people don't. And that's how inflation turns knowledge itself into capital. Then came 2008. The global financial crisis should have been a reset, a chance to rebuild something honest. Instead, it became a masterclass in controlled inflation. Central banks created trillions in new money to rescue the system. Not by handing it directly to citizens first, but by pumping it into banks and financial markets. Asset prices recovered quickly. Stocks rose, property rebounded. The people who already owned things got relief almost immediately. Wages did not. Quantitative easing, the technical term for printing money through bond purchases, made it sound like a sterile fix. But it wasn't sterile. It was a historic redistribution through asset inflation. Those who owned thrived. Those who rented waited. It wasn't corruption, it was policy. Then in 2020, the cycle repeated under a global pandemic. This time, governments injected money directly into households to prevent collapse. Demand surged while supply chains broke. Inflation jumped higher than it had in decades. And once again, history rhymed. The stock market hit record highs. Real estate became unaffordable. And the same people who benefited from low interest rates now profited from scarcity itself. For a moment, the public thought inflation was back because of greedy corporations. But that wasn't new greed. It was the same incentive structure the system had rewarded for years. Some people were just better positioned to take advantage of it. Because inflation doesn't choose winners. It amplifies whoever already has leverage. Look at any major inflationary period and the pattern repeats. In Weimar Germany, the middle class lost everything while industrialists holding real assets emerged stronger. In post-war Britain, inflation quietly wiped out national debt while savers saw pensions eroded. In 1970s America, stocks stagnated, but real estate and commodities made fortunes for those who could afford them. And in the 2020s, the richest households gained massively, while median families struggled to keep up. Different eras. Same formula. Inflation is one of the oldest wealth transfers on Earth, and one of the most respectable. People blame greed, politics, supply chains. But those are symptoms. The root cause is structural. We built an economy that depends on credit expansion, and credit expansion requires inflation to survive. The alternative isn't perfect stability, it's collapse. That's why even when central banks talk tough about fighting inflation, their mission is rarely to eliminate it. It's to manage it, to keep it contained, to keep it believable, to make it feel like stability while the currency quietly erodes beneath your feet. Because if inflation truly went to zero, growth would slow, debt would tighten, and the machine would seize. So the war on inflation becomes a performance, a delicate dance between credibility and necessity. Rates rise, markets panic. And then, just before something breaks, policy shifts again. Because deep down, everyone at the top knows. A little inflation is a small price to pay for keeping the system alive. But there's something deeper than policy here, something psychological. Inflation doesn't just change numbers, it changes behavior. It teaches people to consume now rather than plan later. It punishes patience. It rewards risk. Saving starts to feel pointless. Spending feels rational. Speculation feels like hope. And over time, this creates the perfect citizen for a debt-driven system. Always chasing, never stable, perpetually trying to catch security that keeps moving further away. That's how inflation becomes a culture. We call it growth. We call it prosperity. But underneath, it's the same cycle that has powered empires for centuries. Devaluation, reinflation, rediscovery. It keeps governments solvent, banks liquid, and the public distracted. And once you see it, you can't unsee it. Because inflation is not random. It's how power measures time. It rewards those who live in the future, the ones who borrow, invest, and control credit. It punishes those who live in the present, the ones who earn wages, save what they can, and spend what they have. And it forgets those who live in the past, the ones who still believe money should hold steady value. That's why the rich love inflation, and most people don't. To them, it isn't theft, it's strategy. Every generation learns the same painful lesson. The value of money is never fixed. The only question is whether you're the one losing it, or the one deciding what it's worth. Inflation didn't appear out of nowhere. It's the natural consequence of a world that wants everything now. and pays for it later. It's the quiet engine of debt, the fuel of empires, the lifeblood of a system that must always expand, even at the cost of the people inside it. And yet, here's the paradox. Without it, everything can collapse. Deflation crushes borrowers, breaks banks, and freezes trade. Inflation keeps the gears turning, even if it grinds people down along the way. That's the moral equation of the modern economy. Growth at almost any price. So the next time you hear that a little inflation is good for the economy, remember who it's good for. Not the worker saving for a house, not the retiree living on a fixed income. It's good for the people who already own the house, the people with leverage, the people positioned closest to the flow of new money. Inflation isn't a glitch in capitalism, it's capitalism, running at full speed, uphill, with your wallet in its pocket. Because in the end, inflation isn't the fire, it's the oxygen. And the world we built can't breathe without it. If this video raised questions about how money truly works, subscribe to Moneta Historica for more. Money speaks, history hides, we uncover.